Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oracle Corporation.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, let's unpack this. For years, the story around Oracle was, legacy software, stable,
Yeah.
but maybe a little boring.
That script has been completely thrown out the window. It feels like we're talking about a different company now.
Right. So the real question for you, the listener, is whether this pivot into an AI-first hyperscale cloud player is real.
Or if the market is just, getting a little ahead of itself.
Exactly. Let's jump right into the engine driving this whole narrative, the growth.
The shift is, it's pretty definitive. If we look at the last quarter, Q2 of fiscal 26, total revenue was up.
Yeah.
About $16.1 billion.
That's a 14% jump year over year, which is solid, but that's not the real story, is it?
No, not at all. The true signal is inside the cloud division.
And that's now, something like 77% of their total business?
It is, but the aha moment, the thing that really gets you, is the acceleration.
Okay, so tell me about that.
Well, total cloud revenue grew 34% year over year in Q2.
Sure.
But the quarter before that, in Q1, it was 28%. So it's not just growing, it's growing faster.
And that sequential acceleration is so critical, right?
Yeah.
Why is that such a big deal for analysts?
Because it signals capacity absorption. I mean, when you're building out all this expensive infrastructure, the big fear is
that nobody will use it.
Exactly. So when growth speeds up like that, it tells you that every bit of capacity they bring online is getting soaked up immediately by demand.
It's the clearest validation of their spending you could ask for.
It is. And within that cloud story, the real star, the part tied directly to this AI boom, is OCI.
Oracle Cloud Infrastructure.
Right. And OCI reported, get this, 68% year-over-year growth.
68%. That's an incredible number. It confirms they're attracting those really high-demand AI workloads.
The ones that really matter. And what's fascinating is the profitability that's coming with it.
Yeah, you'd think with all that spending, margins would be getting crushed.
But they're not. Net profit margins have actually expanded over the last 12 months, up to 25.3% from about 21.2%.
So the new business they're bringing on is very, very profitable.
It implies the unit economics are just that strong.
Okay, so that explosive growth is there. But how do we know this isn't just a short-term bump? We need to look at the contractual security behind it.
Which brings us to the number that has everyone's attention. The backlog, the RPO.
Remaining performance obligation.
And this is probably the single strongest argument for their long-term revenue. RPO hit a massive $523 billion.
Wait, say that again? $523 billion.
Billion, with a B. Think of it as contractually obligated revenue that customers have already promised to spend. It's basically locked in.
That number just needs context. How much did it grow in just one quarter?
It was a sequential increase of $68 billion.
So a 15% jump in 3 months.
And this isn't just small deals piling up. This is anchored by huge, multi-billion-dollar commitments from marquee clients. Names like Meta, NVIDIA.
So the biggest AI players in the world are effectively prepaying Oracle for cloud capacity.
It's a massive vote of confidence, and it's what gives credibility to their very aggressive growth targets.
Right, the one where they're aiming to grow OCI revenue from about $18 billion this year
to a targeted $144 billion by 2030.
An 8-fold increase in 4 years. I mean, if any other company said that, you'd probably dismiss it as hype.
Normally, yes. But when you have over $500 billion already contracted in the RPO, that backlog gives you a roadmap. It makes that huge goal seem, addressable.
The demand side is secure, so the main challenge is just execution, building it all fast enough.
That's the whole game.
Okay, so if the growth and the backlog are the offense, what's the defense? How are they managing to grow so fast in a market dominated by Amazon, Microsoft, and Google?
Well, that's the strategic nugget that's so interesting. Their moat is still rooted in their database leadership.
The high switching costs. It's just too hard for big companies to move their core Oracle databases.
Exactly. But the real innovation is their multi-cloud strategy. They basically realized they couldn't beat the hyperscalers everywhere.
So they decided to join them, in a way.
Right. They're building 72 multi-cloud data centers inside AWS, Azure, and Google Cloud regions.
That sounds completely counterintuitive.
It does, but it's brilliant. They're turning their biggest competitors into distribution partners.
So a big company that lives on Azure can now access Oracle's high-performance database without ever leaving their preferred cloud.
Precisely. And we have smoking gun evidence that it's working. That specific multi-cloud database business is their fastest growing segment.
By how much?
It reported 817% year-over-year growth in Q2.
817%. Okay.
So that's just deepening their customer lock-in across the entire industry. And it shows real strategic discipline on the hardware side, too.
You're talking about the chip neutrality idea, selling their stake in Ampere.
Yeah, instead of trying to fight the hardware war against NVIDIA, they're just saying, we'll buy the best chips on the market for our customers. It reduces risk and lets them focus capital on the data center build-out.
Which makes sense. And the final proof is that the biggest AI models are reportedly running on Oracle Cloud.
Which is a huge stamp of approval. But we have to transition to the risk factor, because it's a big one. It's the core of the bear case.
The capital expenditure.
The CapEx intensity, the sheer volume of investment required to build everything needed to fulfill that $500 billion backlog.
And we were talking about, what was the projection? Something like $50 billion for this fiscal year alone.
$50 billion, a gargantuan number. And that spending has consequences.
First, debt. It's driving their debt load way up.
Potentially near $200 billion. And second, and maybe more painfully, it's pushed their free cash flow into negative territory.
For a company that was always a cash-generating machine, seeing negative FCF is, well, that's alarming.
It is.
So if I'm an investor who cares about cash flow, why shouldn't I be running for the hills right now?
Because you have to see it as a front-loaded investment. They're forced to spend that $50 billion now to fulfill the massive contracts they already signed.
So the CapEx is just the price of admission for the AI boom.
That's the argument. The massive RPO backlog is the ultimate mitigation for the risk. They aren't speculating on demand, they're building for demand that's already there, in writing.
So the current FCF pressure is just a temporary strategic trade-off.
That's the bull case.
Okay, which brings us to the stock itself. We've seen a lot of volatility. It's had a pretty big drawdown from its highs.
For sure. There's been broader sector rotation, and the market is definitely concerned about that high CapEx we just talked about.
But some analysts are calling this a potential accumulation zone.
They are. Consensus price targets are substantially higher than where it's trading now, somewhere in the low to mid 300s. It suggests analysts see a disconnect between short-term jitters and that long-term value.
A lot depends on the macro environment too, right?
Absolutely. This is a long-duration growth story, so it's sensitive to interest rates. If the Fed signals lower or even stable rates, that would be a huge tailwind.
So looking forward, what are the key catalysts we need to watch for over the next 3 months?
The big one is the Q3 earnings release. We need to see sustained cloud growth, ideally above that 30% mark.
And you'll be watching OCI traction specifically.
Yes, needs to stay aggressive, hopefully above 60% growth. And crucially, we need to see that RPO backlog continue to expand.
To show that demand is still outpacing their build-out.
Exactly. And beyond earnings, any updates on those new cloud regions, those 72 embedded data centers, serve as proof points that the multi-cloud strategy is working.
So to synthesize this, we're looking at a legacy company that seems to have successfully shed its old skin.
I think that's right. The core thesis is that Oracle is really executing this transition to an AI-first cloud platform. They're using their database moat and those clever multi-cloud partnerships to lock in years of revenue.
That $523 billion RPO.
That's the number. The short-term pain of the high spending is, the necessary investment to achieve that massive long-term scale.
So the whole story really just hinges on execution. Can they build the capacity fast enough to match the contracts they've already signed? If they can, this is a powerful long-term story.
Thank you for joining us today on Smart Wealth with Joshua. Don't forget to hit that subscribe button for your daily analysis and investment insights.